You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Partner Bill.
Yes.
And I go way back. Do we have a mic for Alan? Yeah, they'll mic you up quickly. So I'll tell a quick story. I met, Bill's been Girton Asset Management, a sponsor of the event forever, and an LP in our fund, and an investor in Stocktwits. And they're in La Jolla, probably one of the largest fixed income managers in the country.
Largest muni bond.
Largest muni bond.
Not the largest, one of the largest.
One of the largest muni bond managers in the country. Bill's in Machu Picchu,
Machu Picchu?
With the family hiking. Alan, so tell us a little bit about the firm and what you do at Girton Asset Management and muni bonds in general.
Yeah, so we're pretty much exclusively a municipal bond shop, all very high quality. And we work almost exclusively with ultra high net worth investors, and we do that primarily through the RIA channel. So, firms like Red Holtz, like Josh that was up here earlier this morning, those type of firms as an intermediary for us.
How do you so as an intermediary, how do you market to them, or they just discover you?
We do a little bit of everything on that. So we do some outreach. We have a little bit of marketing. We're not exactly a household name, so we don't do a whole lot of outreach. A lot of things come through referral. We kind of talk to one person, they introduce us to another person, or we get introduced to a high net worth investor that has talked to an RIA that we know. They're not using an RIA themselves, but they just say, you guys should talk to the guys over at Girton. They do a great job.
And so let's get right into, I got a few charts. So listen, I just refinanced, Dan, my banker's here. Is First Republic here? So they paid me to take out a mortgage. Is this going to continue? Where do we see, the number one question you get is, how is this possible? What's happening? What does it mean?
Yeah, it's interesting. We've had a tremendous rally just in the last 3 years in fixed income markets and muni bonds as a whole. It's we're getting to the point where the 30-year bull market in bonds is now the 35-year bull market in bonds. And so I think if we look out in the future, we had one interest rate hike at the end of last year and then absolutely nothing so far this year. Yields have only continued to come down. They went up a little bit in the last quarter, but that was the first quarter that we'd had interest rates rise in over a year. And a lot of that was just because the second quarter ended right after the Brexit vote happened. And so you had a huge drop in yields right at that time. Yields kind of bottomed right after that. So looking forward, ultimately, can they go much lower? Well, we used to think that yields couldn't go lower than zero, but we've kind of learned a different story right now. I think a lot of it's going to be determined by what happens overseas. I think that we will see the Fed start to raise interest rates again, possibly in December, depending on the outcome of the election. I think they'll be extremely slow, but the problem is that it's hard to see the longer-term yields continuing to go any higher if we don't have some carry forward in Europe and Japan. There's such a weight being put on the 10-year Treasury and the 30-year Treasury, because if you're in Europe, it makes a lot of sense to buy those with the idea that the outlook for the dollar is probably pretty good relative to the euro or the yen right now, and you're not getting any yield. In fact, you're basically having to pay to own bonds in Europe right now. So
it's hard for the average percentage. So you at a firm, so let's go to the, so tell me what this means.
Yeah, so this is something
people hear it on the news and I'm like, what does that mean?
Yeah, what we look at a lot is the spread between BBB securities and AAAs and the munis as a kind of proxy for how investors are pricing risk in the market. And what we tend to see is that there's a very herd-like mentality in the municipal market. It's almost all retail investors. Because of the tax exemption, you have really no institutional presence in the market. And so over the rally that we've really had over the last 3 years, you've seen kind of the price of credit get cut in half. So what people are demanding that they're getting paid to take on credit risk relative to where kind of AAA munis are, that's gone from being about 150 basis points of spread to 75, 80 basis points today, and it just kind of continues to move downward. And what that tells us is it's just that you're in a setup where your expected returns, if you're taking on risk in the market right now, even though the returns have been very good for the last several years, your expected returns looking forward are not very good. And so finding value in the market is very difficult.
So people call you probably freaking out. I mean, they've got their money with you. You can't make them, the risk is high, it seems.
The funny thing is people often confuse total return in this market with actual underlying yield. And so actually people aren't freaking out at all because the returns have been very good. They freak out in 2013 when we had the taper tantrum and most bond funds were down multiple percentage points for the year. And people don't think of their bonds as being someplace where they can lose money. That's when they freak out. The idea though is that was the perfect time to go out and invest, to take on a little bit more risk, to take on duration, because you were finally going to get paid for it. Right now you're not getting paid to take on credit risk. You're not getting paid to take on duration, kind of in aggregate. And so people get lulled into this false sense of security because their historic returns have been really good, but they're not thinking about the forward-looking picture and the fact that underlying yields are very low right now.
Got it.
And so, yeah, we don't get a lot of people freaking out. We do get a lot of questions of people looking to invest new portfolios thinking about, well, gosh, yields are really low. How should I think about this? How are we going to charge fees on this? Those kinds of questions.
Got it. Okay, so now next, we're looking at money market reform. What does this mean?
Yeah, so probably not many people in this room are very concerned with money market reform, but it's something at Girton we've found really interesting and we've been tracking basically the entire year. And this reform actually goes into place today, so it's very timely. And the idea is if you go think back to 2008, money market funds have been able to peg a $1 NAV for their entire history, effectively. And in 2008, when short-term corporate debt, commercial paper markets got really locked up, there were a couple of funds that were basically going to have to break the buck, is what they were calling it. The government basically had to come in and shore them up so they wouldn't have to break it. So some of the new regulation out there is going to require that all prime money market funds have to report a floating NAV. What this means is that if you're in a money market fund that invests in anything outside of straight U.S. government debt, so if you're in commercial paper, tax-exempt money market funds, when you go in and look at your account on Monday, you're not going to be at $1. You might be at 99 cents or 101. Volatility is going to be extremely minimal, but people aren't used to thinking of it that way. They're thinking of it as cash. So they don't expect to see any level of volatility in there. And so what we've seen is a lot of institutions have just decided to stop offering prime money market funds as a whole. So for instance, Schwab, they're moving away from that completely. All of their money market funds are going to be government only going forward. Mm-hmm. What this has meant is that over the last 6 months or so as they started the transition, there's been a tremendous amount of selling from these sources of short-term commercial paper, tax-exempt stuff like municipal bonds, and buying of treasuries to replace that. And so that's put a lot of stress on the market, as you've had that crossover. And that's led, and this is 1-year bonds that we're looking at here. If you looked at even shorter, like 3-month and 6-month securities, AAA munis are now yielding roughly double what a 6-month treasury is. And this is in a market where you should see the yields being, 20% lower in munis given the tax exemption than where they are in treasuries. And so it's kind of an opportunity for investors in that short side of the market to move into, munis.
So tell me about stupid people or what's going on here with this ARC.
Yeah, so...
Because munis are in a way like stocks, like people don't understand that.
There's a huge amount of misunderstanding and misconception. So you're familiar with the story of Noah's Ark, correct?
I'm not, actually.
No, never heard of it? So we talk a lot about in the muni market, there's kind of two sides of the muni market. There's the traditional muni market, and then there's things that are able to issue in the tax-exempt market. And that tax-exempt market can mean anything from a government, a state or county or city government, all the way to things like a stadium or a parking lot or an airport, or in this case, a religious tourist attraction. So there's a religious nonprofit called Answers in Genesis. And some of you may have heard of it. They've created these creation museums where they basically have exhibits of people walking around with dinosaurs 6,000 years ago. So they decided they wanted to build a 2-scale replica of Noah's Ark in rural Kentucky as a kind of tourist attraction. It cost them $100 million to build. They were actually able to finance $62 million of that by issuing municipal bonds. Now here's the key, and here's kind of the trick that people don't often understand about the municipal market, is that the issuer name for those bonds is actually what's at the top of that slide right there, the Williamstown, Kentucky Taxable Industrial Building Revenue Bonds. And if you actually looked on a statement, it actually would be abbreviated, so you wouldn't even be able to tell that was exactly what it said. Nowhere in that issuer statement does it say anything about those revenues being backed by this ARC project. ARC Encounter is what it's called. And so you literally would have to go into the financial statement
But
or
that's
the
the
offering
opportunity.
statement. Well, in this one, it's a risk.
Yeah.
We think that the chances of these bonds defaulting are probably close to 80%.
But say it rains a lot, it'd be a good investment.
Well, it could be a great investment if we have a massive flood. But I mean, just to give you an idea of some of the projections, they're projecting that this is going to see 1.2 to 2 million visitors a year starting this year. It's in rural Kentucky, in the middle of nowhere. The admission cost is $40 per adult. You actually have to pay to park, even though it's in the middle of nowhere. To give you some perspective, the San Diego Zoo, which is the highest grossing zoo in the country, gets about 3 million visitors a year. It's in one of the biggest cities and tourist locations in the country. We think that the projections for the attendance in this art are way overstated. The odds of this, going bankrupt are extremely high.
So interesting. So now let's talk about Friday Night Lights. What do you mean by this?
Yeah, and so this would be something where we can talk a little bit about another eccentricity in the market, and this is more one where we would see an opportunity. So, I'm from Texas originally. I played football in Texas. Everyone knows people in Texas like football, and they like things bigger and better, right? So you might not be surprised to find out that there's not one, but 3 high school football stadiums that have been built in Texas recently that cost over $60 million to build. So the irony here is if you think about, we talked about the non-traditional municipal market earlier. So there's a lot of professional football stadiums that have issued debt, right? And we have been cautious on that sector as a whole for a long time. A good example would be like the St. Louis Rams, which are now the LA Rams. So they still have debt outstanding on their football stadium in St. Louis. There is absolutely no team that plays in that stadium. So how is that bond, going to get paid back at this point? And we actually sold out of the city of St. Louis bonds that we owned because of that move, because the city has some tie to that stadium and may need to go in and actually pay the bondholders for that stadium back. The irony, though, is that we're actually very comfortable with the bonds that stand behind these high school football stadiums. And the reason for that is that they're not backed by revenues that come from the stadiums themselves. These are tied in with the school district bonds in the specific cities and counties in Texas where these stadiums are. And so it's actually the taxpayers, the property taxes for that region. And these are high quality suburbs right outside of Dallas and Houston where they're doing this. And so these actually tend to be very high quality bonds because they're actually school district bonds, not a stadium bond. And on top of that, in Texas, there's something called the Public School Fund. Texas has done something really smart, and they have a rainy day fund. Basically, excess oil and gas revenues every year that come in, they go into this public school fund. There's roughly $30 billion in that fund now. The only thing that can be used for is to back debt issued by school districts within Texas. So most school districts in Texas have a AAA rating. We rate them very highly. You can often buy them at yields that would be much higher than things that we would see as having a similar level of quality. And I think it just goes to show how misunderstood the market is and how people generally don't understand what they own in that market. And we see this all the time. These bonds are getting sold through brokers. They're not doing any research. And so that's kind of what we try to shed a little bit of light on.
So how do people do business with Gura? What's the net? Well, how do you open an account?
Yeah, so most people would come to us through an RIA, and so their RIA would handle most of that. But for people that come to us directly, we do almost all separate account management, meaning you would own the individual bonds as opposed to it being a commingled vehicle. We do have a couple of mutual funds available, but they are only about 5% of our business. We have relatively high minimums. Most of our strategies have $1 million plus minimum associated with them. So it is definitely a high net worth type of a situation. But once you do that, it's very easy. We work with roughly 36 different custodians. So if you have an account at Schwab, we can work with you at Schwab. All we have to do is basically get appointed as the manager and then enter a direct contract with the client, and we can start managing the bonds for them. You can fire us at any time, remove us, you still own the bonds.
At what net worth does someone start thinking about municipal bonds?
Well, I think they start thinking about them at any level. I mean, it really doesn't matter. As long as you're paying taxes, it can make a lot of sense to own municipal bonds. If you think about a taxable equivalent basis, what you're going to get rates that are very similar to lower quality corporate bonds on an after-tax basis. but with a much higher level of credit quality and typically a lower level of volatility associated with that as well. I mean, if you think about defaults in the municipal sector, extremely low historically, particularly if you're talking about the traditional municipal side of the market, where corporate bonds, you start going down below, kind of investment grade status, the default rates historically start to trend up pretty aggressively. And we saw a lot of that last year. I mean, the number of oil companies that have defaulted over the last year or so is incredibly high. And people that are speculating on that are now kind of holding the bag on that, where you see it very, very few times. So for anyone who's a taxable investor that needs some kind of fixed income allocation, munis make a lot of sense. Now the question is just, at what asset level does it make sense to have a separate account versus using a mutual fund? And I think it would typically be, if you're going to be at the threshold where you're going to have $1 million in a municipal fixed income strategy, that's where it starts to make sense, where you can get the appropriate diversification by owning individual bonds and still have liquidity in there.
Otherwise, a mutual fund.
Otherwise, a mutual fund probably makes a lot of sense.
So I don't know, let's stick around. But I appreciate your support and teachings of how this all works. You keep it really simple, and I appreciate it.
Yeah, thanks a lot.
Thank you.
All right.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com.